Hello, in this video, we're focusing on the practical concepts that you can actually apply in the real business world. Hope you enjoy it. Let's get on with it. Many business owners believe that making a profit means their company is financially healthy, but that's not always the case. Sometimes profits can actually hide a deeper problem with cash flow. The day-to-day movement of cash in and out of a business is what keeps it running. But profits alone don't guarantee there's enough cash on hand to cover bills, taxes, and other expenses. In fact, this disconnect is known as the cash trap. It's when a business looks profitable on paper but struggles to pay its immediate obligations. Understanding this difference is crucial because without managing cash flow effectively, even profitable founders can find themselves in serious financial trouble. Many business founders assume that if their company is showing a profit on the profit and loss statement, they must be financially healthy. However, plenty of profitable businesses fail each year because profitability doesn't always mean there's enough cash flow to keep things running. This problem happens because profits are reported using accrual accounting, which recognizes revenue and expenses when they are earned or incurred, not necessarily when cash moves in or out. Meanwhile, a business actually survives on cash flow, which is affected by how quickly customers pay their bills, how much inventory is tied up, and how long the business waits to pay its own suppliers. These parts of working capital, accounts receivable, inventory, and payables, can quietly consume cash as the business grows, creating a cash trap. This means a business might appear profitable, but still run short of cash. Understanding this gap and learning how to spot it early is crucial. We'll look at how working capital impacts cash flow, real-life examples, and ways to manage growth while keeping the business solvent. By the end, you'll have a practical framework to help protect your business from running into this common cash flow pitfall. Profit and loss statements show performance, but they don't reflect the cash situation of the business. This is because under accrual accounting, revenue is recorded when it's earned, not when the cash actually comes in, and expenses are recorded when they're incurred, not when they're paid. Non-cash items like depreciation or provisions affect profit, but don't move any cash. Cash flow, on the other hand, tracks the real money coming in and going out of the bank account. This difference can create a false sense of security. Your company can appear profitable on paper while running out of cash for day-to-day operations. This gap between profit and cash flow is especially risky for founders during growth phases, when the business needs more working capital and cash demands can grow faster than profits. Recognizing this mismatch is key to avoiding financial trouble. As a business grows and becomes profitable, it often needs more cash just to maintain that growth. This happens because every new sale usually demands more inventory, and with more customers, there are more invoices waiting to be paid. At the same time, suppliers expect payment even before those customers settle their bills. So, even though the business shows a profit, the cash required to cover these ongoing costs can outpace the cash coming in. This situation is what we call the cash trap. It's important to recognize that being profitable doesn't necessarily mean having enough cash on hand. Many founders describe it as being profitable, but always short of cash, which means that the challenge isn't a failure in running the business, but a financial management issue related to working capital needs during growth. The faster the growth, the more cash is tied up in day-to-day operations. Understanding this helps in managing finances better and avoiding surprises despite appearing healthy on paper. Working capital is the difference between what a business owns in the short term, like cash and inventory, and what it owes, such as bills to suppliers. For founders, it's important to focus on three main parts: accounts receivable, which is money customers owe you; inventory, which is cash invested in your stock; and accounts payable, or money you owe to your suppliers. When your business grows, changes in working capital show whether you're freeing up cash or using more of it. If your accounts receivable and inventory rise faster than accounts payable, you'll need more cash just to support growth, which is why managing working capital is crucial to avoid running out of cash, even when the business seems profitable. When you sell £100 of product with a 40% gross margin, it looks like you make £40 profit before overheads, which seems positive on your profit and loss statement. However, the timing of cash flows tells a different story. Your customer pays you after 60 days, but you have to pay your suppliers within 30 days, and you need to purchase inventory even before making the sale. This means money leaves your business well before any cash comes in. As a result, every new sale actually widens the gap of money owed, turning what looks like a profitable business into one that is cash negative. This gap in timing creates an ongoing need for additional funding, even though on paper the business shows profit. When your revenue grows, but your customers take longer to pay, your accounts receivable increase, which ties up cash. This is a common issue because rising sales that don't turn into immediate cash can create big problems. Watch out if your revenue is going up faster than the cash you're actually getting in, or if your days sales outstanding, that's how long it takes to get paid, is creeping higher. Also, be careful when big customers start setting extended payment terms. Founders often feel excited about landing major clients, but don't realize these large customers can delay payments, effectively using your cash like a bank. Even with double the revenue, if your receivables balloon, your cash can dry up, putting your business at serious risk. Inventory is often overlooked as a major drain on cash. Founders commonly make the mistake of over-ordering to get volume discounts, keeping extra stock just in case, or expanding product lines without controlling inventory carefully. While inventory shows up as an asset on the balance sheet, giving a false sense of security, it's really cash that's been tied up and lost its flexibility. Until that inventory is sold and the cash is collected, it can't be used to cover essential expenses like salaries or rent. Managing inventory well is critical because it directly impacts the company's cash flow, even if it doesn't immediately show in profits. Stretching accounts payable by delaying payments to suppliers might seem like an easy way to improve cash flow temporarily, but this approach has its limits. As your business grows, suppliers usually shorten payment terms, requiring payments sooner than before. This reduces your flexibility in cash on hand. Additionally, when you delay payments, you often miss out on early payment discounts that can save money. Over time, pushing suppliers too hard can harm relationships, which might mean less favorable terms or supply issues down the line. So, while managing accounts payable can help in the short term, it's important to recognize it becomes more challenging as your business scales and cash demands increase. Many founders focus mainly on the profit and loss statement, paying close attention to revenue, gross margin, EBITDA, and net profit. However, they often overlook critical measures like the cash conversion cycle, working capital days, and operating cash flow compared to profits. This oversight creates a dangerous blind spot because having a profitable P&L doesn't always mean there's enough cash on hand. Growth can feel rewarding emotionally. It's exciting to win bigger customers, hire more staff, and gain visibility. Yet without strong cash discipline, growth can actually destroy value, even when it seems like success. Founders usually only realize this when they start struggling to meet essential expenses like payroll. Adding to the challenge is the accounting language itself. Terms such as accounts receivable and inventory sound technical and detached, so founders might not naturally connect them to unpaid sales or cash that hasn't yet been realized. This disconnect can delay important actions needed to improve cash flow and protect the business from cash traps. This example shows a professional services firm that was growing quickly and appearing successful on paper, with strong margins, blue-chip clients, and consistent profits. However, despite these positives, the company faced a major cash flow problem because their clients took 90 to 120 days to pay, while staff needed to be paid monthly. To keep up with the growth, they had to hire staff before the revenue from new clients came in, which worsened the cash situation. As a result, although profitability improved, the business's cash position got worse, forcing the founder to inject personal savings just to keep things running. This illustrates that the business wasn't actually unprofitable, it was just financed poorly, and the mismatch between cash inflows and outflows created a cash trap that many growing companies face. The company expanded quickly into new retail locations, and while each store was profitable with good gross margins, the cash situation quietly deteriorated. They had to stock inventory up front for all these stores, which tied up a lot of cash. At the same time, the retailers they sold to had long payment terms, so the company wasn't getting cash back quickly. On top of this, increased central overhead costs put additional strain on their finances. Even though the stores were making profits on paper, the cash was being absorbed faster than those profits could turn into available cash, leading to the company's collapse. This example highlights how strong unit-level profitability can mask underlying cash flow problems when working capital isn't managed carefully. This manufacturing company landed a significant contract that brought in much higher volume and improved their profit margins, which resulted in strong headline profits. However, this success masked a big cash flow problem. They had to buy a lot of raw materials up front to meet production demand, which tied up a large amount of cash. At the same time, work-in-progress inventory built up as items were still being made, so the cash was locked in unfinished goods. On top of that, their customers were paying late, which delayed cash coming in. Despite showing solid profits on paper, this contract actually drained their cash reserves and pushed the company into financial distress. It's a clear example of how growth and profitability alone don't guarantee healthy cash flow, especially when working capital spikes and payment terms aren't managed carefully. Start by comparing profit to operating cash flow, because healthy businesses generally show that cash follows profit over time. If you see profits rising, but operating cash flow isn't keeping up, that's a red flag you need to investigate right away. Next, track the cash conversion cycle, which tells you how long your cash is tied up in the business. It's calculated by adding days sales outstanding and days inventory outstanding, then subtracting days payables outstanding. If this cycle gets longer while your business is growing, it's a warning sign that cash is getting stuck somewhere, even if profits look good. By keeping an eye on these two key indicators, you can spot cash flow problems before they turn into bigger issues. It's crucial for founders to track more than just profit by developing a 13-week rolling cash forecast, which helps predict short-term cash flows and avoid surprises. It's also important to build growth scenarios that clearly show how cash changes under different conditions, including stress tests, to understand worst-case liquidity situations. Without modeling cash, growth plans miss a key part of the picture, since profitability doesn't always mean cash availability. When setting growth targets, consider how much cash is needed for each pound of growth, when the business will become cash positive from that growth, and how much of a funding buffer is necessary. This approach shifts the focus from just hitting sales numbers to making smart capital allocation decisions that keep the business financially healthy. To improve receivables, it's important to shorten payment terms, send invoices right away, and consistently follow up on collection. Offering discounts for faster payments can motivate clients to pay on time. On the inventory side, reducing the number of SKUs simplifies management, while better demand forecasting helps avoid overstocking. Moving toward just-in-time inventory practices where possible can free up cash, and slow-moving stock should be sold off quickly to avoid tying up funds. For payables, negotiating longer payment terms gives more breathing space, and aligning payments with when cash actually comes in helps avoid shortages. It's also critical to avoid relying too heavily on any one supplier to maintain bargaining power. When considering growth, focus on strategies that generate cash quickly, delay expansion until you have sufficient funding, and prioritize customers who turn over cash faster. All these practical steps work together to keep cash flow healthy and help avoid falling into the cash trap. Understanding the cash trap gives you several key advantages. It helps prevent business failure that could otherwise be avoided, improves the quality of decision-making during growth phases, boosts the founder's confidence, and enhances credibility with investors. It also ensures that the business strategy stays aligned with financial realities. Founders who grasp cash dynamics can grow their companies faster, but with less risk. However, there are trade-offs to this approach. Growth may appear slower on the surface because cash discipline can restrict how quickly you expand. Tighter controls, like stricter credit policies, can create friction with customers, making relationships a bit more complex. Managing cash closely also demands more financial sophistication and can increase management complexity. Sometimes being very cautious with cash might mean missing timely opportunities or delaying strategic actions. These trade-offs are important to understand, not as reasons to ignore cash, but to balance growth ambitions with a realistic, sustainable financial approach. Profit is an important starting point, but it isn't the whole story. Cash flow is what really keeps a business alive, and free cash flow is what creates real value. A company can look great on paper with strong profits and growth, but if it can't turn that profit into cash, it won't sustain or build value over time. Founders often run into trouble not because they lack skill, but because they confuse profit with liquidity. When growth demands more working capital than profits can cover, a cash trap forms. Accrual accounting can hide this problem, and stories of success can delay necessary action. Learning to understand working capital isn't just about accounting, it's a survival skill. Founders who focus on cash gain more control, resilience, and ability to plan strategically. Those who don't realize too late that recorded profits don't pay bills or salaries. Ultimately, cash is the essential lifeline of any business. Profit shows if the company is winning, but cash decides if it will last long enough to matter. If you found this video useful, there's plenty of more business and finance videos on the channel that you'll enjoy watching and get great practical value from. In the meantime, thanks for watching.